Welcome, everybody. We're going to get started here in just a couple of minutes. We're going to be talking about ways to save on lifetime taxes and specifically about this change within the tax code that occurred, well, it sunsetted last year, the subsidy cliff. While we're waiting for people to come in, got a couple of polls. I don't even know how this works, so let's just see how this works. Answer in the chat, or somehow you're supposed to be able to answer this poll. Did you know that a rocket will crash into the moon tomorrow morning? If you've got the answer, click on that. Tell us. And I do see there's people showing up, so that'd be good to see if this poll thing works. It's really new to StreamYard. I thought it was very interesting. Did you know that a rocket will crash into the moon tomorrow? And while we're waiting for people to respond, wanted to give you a little bit more background about the presentation here. This is coming from the Podcast Editor Academy. This will actually be a Podcast Editor's Mastermind Show episode that'll come out in the audio stream in a couple of days later. So you'll have the opportunity to rewatch this in its entirety, or even if you just jump to the certain chapters where we talk about something. All right, somebody answered the poll. Fantastic. Yeah, the Jupiter, not Jupiter. What is it? The Dragon 9, I think it is a SpaceX one of the modules that it didn't have enough fuel to come back to the Earth, so it was just sitting out there, and it's going to crash in the moon at like 3 in the morning in New York time, which is very interesting. All right, let's go to the next one. Will you be attending a PodCon in the next 6 months? So for the next 6 months, there's a few still happening here. Obviously, we got the fall coming up. You got Podcast Movement happening in New York, and then in January you've got PodFest. But even more sooner than that, more sooner, is that a really good word? We have the Empowering Podcast Conference happening in Charlotte. That's a really smaller group of people, but it's really interesting to me. I think I'd like to go to that one sometime. That'll be August 21st through 23rd. So will you be attending a PodCon in the next 6 months? Answer that poll if you have the capability, and we'll see if we've got people showing up those places. Yeah, I should probably answer myself. No, I don't go to any conferences except FinCon until I get this new mortgage paid off. Hopefully soon. It's not much longer. All right, and then one more, and then we'll have people who are showing up here. One more poll. Have you heard of the subsidy cliff before? If you've heard of the subsidy cliff, answer the poll in the video, because that's really a focus of what we're talking about today, and we need to know, is this something that people are familiar with? And maybe I should have had the question say, are you very familiar with, a little bit familiar with, or have never heard it before, because we'd like to know the scale as well. But the subsidy cliff is something new, or it's an impact that's happening in this year, and I might get bitten by it. That's why this webinar is so important to me, and I think that having you guys ride along as I have this discussion with Sean Mullaney, who's going to be our guest coming up here in a minute, is so important, because this is a big deal. All right, I'm going to restart this in a second. Oh, I do see people in the chat. Hey, all right, Heidi's there, Roxana. Great to have y'all here. Thanks for hanging out with us. All right, where'd that poll thing go? I'm still learning these new StreamYard features. They're pretty cool. And now I got to remember where they were. All right. So I'm going to restart, and this is going to become the episode that'll become the Podcast Editor Mastermind Show. So there will be a replay video as well as audio. The video obviously is going to sit on YouTube, and the audio will come out in the RSS feed. Let me take that out. All right. So just a second. Here we go. Welcome to the Podcast Editor's Mastermind Show. I'm Steve Stewart, co-founder of the Podcast Editor Academy, where we teach people how to create businesses as podcast service providers, mostly in the podcast editing field. Today is a very important topic at this day and age, 2026, where I might be having to pay back $24,000 in health insurance subsidies. What's that all about? It's called the Subsidy Cliff. And with me, I'm going to bring on Mr. Sean Mullaney, an advice-only financial planner. He writes for the Plutus Award blog, or Plutus Award winning blog. I've got a Plutus over here too, but yours one for the blog, FiTaxGuy.com. It's on the intersection of tax and financial independence. Not just financial planning, financial independence. And last year, he and Cody Garrett released a book called Tax Planning to and Through Early Retirement. Sean, welcome.
Steve, thanks so much for having me. Looking forward to the conversation.
Yeah, me too. I've been wanting to do something with you for a while. You're very knowledgeable, very easy, approachable person to these topics, which can be complicated and outright boring at some times. And you seem to make them fun and interesting. So we're going to have a pretty good time with this. For those who haven't yet gone through and downloaded the handbook, or the handout, I should say, there's a handout that's going to accompany the topics that we discussed today. It's at podcasteditoracademy.com/handout. Sean's come up with a list of 16 different topics that we're going to talk about. These are ways to save on taxes or to impact your taxable income. And the taxable income is the piece that's really important when you're talking about the subsidies that we get from health insurance premiums or the ACA. Sean, can you explain this ACA thing in a way that everybody in the audience can understand?
Yeah, and let me talk about it for the self-employed individual, and that could be a so-called Schedule C or an S corporation. I'm not worried about that for the time being, but somebody who's mostly working for themselves or their own very small business. So when we have large employers, a lot of us get our medical insurance through the large employer. We pay a percentage, but it's guaranteed issue through our large employer. When we start working for ourselves, obviously our new business does not come with a medical insurance plan for the most part. So where do solopreneurs, self-employed folks get their medical insurance in today's environment, assuming you don't have a COBRA plan from an old employer for a little bit? Let's assume that's not where you're headed. What you do is you go to the ACA, the Affordable Care Act. That has guaranteed issue medical insurance. It used to be called Obamacare, a lot of times referred to as ACA. And when I say guaranteed issue, it means if you apply, they're going to give it to you, right? They don't say, well, you have this pre-existing condition or you're too old or whatever, right? You get it. However, the issue is the retail prices for this, the insurance premiums are quite high. And when the Affordable Care Act was passed in 2010, they knew that this was going to be an issue. That's like, well, great, I can get this medical insurance, but it's very, very, very expensive. Is that even worth anything to me? So they built in as part of the program what is referred to as a premium tax credit. What it does is it essentially reduces your annual premiums based on your income level. What they essentially did was they took a personal expense of ours, medical insurance premiums, and they ran it through the Internal Revenue Code, the tax law. And so what happens is your insurance premiums and the so-called premium tax credit, because they go through the tax law, they behave like a tax, but they're not a tax. And so what happens is as at certain levels of income, you get a certain amount of premium tax credit, and it can be very, very high, which is a good thing. But as we'll talk about, that premium tax credit can fade to zero very quickly if your income is too high. And so a lot of what we're going to talk about today and focus in on is controlling income, because it turns out your income is very determinative of just how much net medical insurance you'll pay under an Affordable Care Act or ACA medical insurance plan.
Yeah, and the change that's happened is at the end of 2025, instead of it being a gradual decline, it's a gradual decline in the amount that you could receive. I could say, I'm going to make numbers here. They are not applicable to anything in real life. I make $80,000, or I plan on making $80,000 in 2025. And let's say I made $90,000. Okay, well, the ACA subsidies would only cover up to $80,000, and then anything over that I claimed there was that repayment I had to make back. It's something like that. This year, if I go $1 over that $80,000 or whatever the 400% of the poverty limit for my family size is, I got to pay it all back. That's why it's a cliff.
That's exactly right. That's exactly right. What they do is they say, what is your household size? Right. That's a big, you got to figure out, all right, do I have kids at home, dependents, right? What's my household size? And they say, you get a premium tax credit, as long as your income falls within certain guardrails. for most states, right, and you got to research your own state, it's generally between 138 of the prior year's federal poverty level of 138% and 400%. You say, well, wait a minute, if my income's below 138% of poverty, I don't get this premium tax credit. The answer is, yeah, you don't in most cases, because they say, well, you qualify based on the income rules to be on Medicaid. So we're not really going to talk about that today. We're going to talk about the other end of this range, 138% of federal poverty level income versus 400%. At 400, between 138 and 400, Steve, you were right. It's just a gradually declining slope. More income, a little less premium tax credit. Sort of makes sense. You're doing better, at least to some degree, it makes sense. You're doing better, so you have to pay more for your medical insurance premiums. But at 400%, once you get $1 over that, guess what happens? Your premium tax credit goes from what's probably going to be thousands of dollars to zero immediately. And that's a change that occurred in 2026. It actually reverts us back to the rules that applied through 2020. I like to say we're in like 3 different historical phases of this premium tax credit. The first phase was 2014 to 2020. It had this cliff effect. 2021 through 2025, they got rid of that cliff effect. They just said, well, keep sloping down. And I think as a practical matter, once your income was 600 or 700% of the federal poverty level, it would just slope down. But in your example, the extra 10,000 of income would have just slightly reduced the premium tax credit. Okay, no big deal. Today, that extra 10,000 of income could just eliminate it. It could go from 10,000, 15,000, whatever for a married couple, depends on your plan, where you live, and it could go to zero. So, controlling income is going to be very important for a lot of solopreneurs who are on this, or Schedule C self-employed, who are on an ACA medical insurance plan.
And we're not doing this to defraud the government. It's a fair program. It's just surprising because of the change that occurred between last year and this year's coverage.
That's right, Steve. So yeah, you have an ability to do tax planning. Tax planning is allowed and very much legal. It involves some ambiguities, and we're not giving anybody specific tax advice in this meeting. We're giving educational information that you can then maybe look at yourself, look at with your advisors. But yeah, tax planning is absolutely a legitimate exercise. I should hope it is.
Yeah, and the disclaimer is that Sean is a financial planner, but he is not your financial planner. If you want to contact him, go for it. But this is all just educational, informational, and hopefully this will be a little bit of fun as we go through that handout that I was mentioning earlier. If you haven't got the handout yet, it's easy to follow along, podcastwriteracademy.com/handout. It'll download a PDF. Or if you're on the web page where this webinar exists, then you can click on to make a Google Sheets copy of it, and you can actually click on things and do things. It'll make a copy to your Gmail account, and you'll be able to follow along with that. So let's talk about the first one. Am I forgetting anything we need to preface here, Sean?
I think we're good. I think we're good, yeah. Steve. Yeah.
Yeah, and we do encourage people to type in your questions in the chat. And if I feel that it's appropriate to interrupt, we'll definitely discuss it right there. The first one that we're going to try to keep ourselves under that 400% of the poverty level for the family size. Try to impact that modified adjusted gross income is delay invoicing.
Yeah. So what happens is when you're self-employed, what's your number one source of income? It's your business income. And what do we all default to, right? We default to, I work in my business and I haven't set up a legal entity, but maybe even if I have, it might have set up an LLC. Either way, I generally default to what's called Schedule C, right? That's a schedule. That's just a form that goes on your tax return. And it says, hey, my business had so much revenue and so much expenses, and the net goes on my tax return. And obviously, the higher that net is, the more challenging it becomes to keep your income below this 400% of federal poverty level cliff. So, you say, well, how do I measure my income? What you default to is the cash basis. So cash is sort of king, right? So, I could do work for a client, say in November and December. And, I finish up before year end. I finish up, say, on December 30th. They've got the final project, the final deliverable, maybe the final version of the podcast episode, all edited. I email that thing out on December 30th, right? the tax law does not compel you to work on New Year's Eve and invoice that thing. You can absolutely say, hey, you know what? I'll just take the end of the year as a little bit of a chill day. I'll celebrate New Year's Eve and I'll go to mass on New Year's Day. And then maybe on the second, I will invoice that. And then your client presumably will hopefully pay that in January. That revenue is January's revenue for tax purposes. Now, two quick thoughts on that. One is delaying revenue is very impactful and sort of in the premium tax credit world, we're trying to win today, generally speaking, but just understand that pushes income into next year and you might be fighting the premium tax credit battle again next year. So there's a bit of a trade-off on that. And then the second thing is when we're in business for ourselves, cash is king. And so we do like to try to collect as soon as possible. But I will say this, there aren't too many clients out there that aren't going to pay because you delayed your invoicing by a week or so. But obviously cash is king as well. So, but delaying invoicing, one thing about the premium tax credit compared to other tax issues, it really is in the accounting world, we have this term permanent difference. So sometimes in tax planning, we think about, well, do I pay tax this year or next year? And if I get it wrong, well, okay, maybe I picked the wrong year, but it's not that, it's just, I could have won this year. I could have won the next year. Sometimes in the premium tax credit, it's like, boy, the second you lose this year, that's it. That's a big loss this year. So I do think delayed invoicing is something that a lot of solopreneurs should consider if they're on, close to that 400% of federal poverty level cliff.
Yeah. And we should define, I mean, Sean was talking about cash basis. There's the way of accounting for your income on a cash basis, which is when you receive it, and there is on the accrual basis, which means on paper you invoice them and you count that as income even though you haven't received the money yet. So be aware of that when you're filing your taxes. That's going to be a big thing. And then the other, and just to reemphasize what he said, we're postponing income to next year. So next year we're going to have more income. So you got to be aware of what you're doing to yourself by postponing and delaying income or delay invoicing, which really, I'm going to say delay income in that way. So you're going to put yourself in a bind in December for cash.
Yep.
And then next year you're going to have even more than what you were expecting because you have December income coming in January or something like that.
Yep. And, it's interesting too, Steve, I myself am a career changer. I was a career W-2 employee until age 40. And now I've been, self-employed to varying degrees for the last 7-8 years. And, when you work for yourself for a long enough time, I have had clients pay before I say, hey, the project's done. Now I want the payment. That does on occasion happen. And if you are a cash basis taxpayer, that is revenue. So not that many clients are prone to do that. And especially if you have continuing clients, you might just have a sort of a course of performance. But that has happened to me in the past where, oh, I just got this deposit. That's great news. I didn't even ask for it. They just paid me. That doesn't happen too frequently, to be honest. But some clients just want to get their life, they want to make a payment and move on with their lives. And so you just never know. Maybe you don't want to be as reliant on this. You want to line up as many ducks as you can, but maybe just don't be as like, okay, I got to make sure I don't get any payments before the end of the year. Maybe that's not the best tactic to take. Maybe, dot some I's, cross some T's, do a few other tactics as well.
Yeah. Communicate with your clients. And of course, doing just one of the things that are on this handout that we gave you or the list that we're going through right now, don't rely on that to be the solution. Just make sure that you're thinking it through as we're going through all these. The next one is accelerate business expenses. So one, we delayed the income to next year. Now we're saying spend more money before the end of the year. And I should clarify that on deductible business items.
That's right. So Steve, there's a lot of play in the joints here. Now, again, it does suffer from the same issue of, well, okay, if I take a business deduction in 2026, that's one less business deduction in 2027. So let me give you just a few examples of this. So maybe I'm going to a conference in late February of 2027. So I can book my airfare in early January, and I'm probably going to get a decent rate on it. Depends on the city and whatnot. But I could just book my airfare in December and have that hit the credit card in December. And now I'm a assuming I'm a cash basis taxpayer. That's a deduction in 2026. You could play with some of those sorts of things, even conference admission. So maybe you're going to a conference in, June or July of 2027, but they're selling tickets now and they even got an early bird. Well, okay, great. Buy that admission in December as opposed to in January or February. Maybe you get an early bird anyway, and you're getting a deduction in 2026. Sometimes this could be useful for equipment purchases, right? Depends on your business. Do you need equipment? Do you need a new computer? But maybe, hey, I need a new computer. And these days, generally speaking, there's bonus depreciation and expensing for very small businesses on things like computers, or I need a new scanner, new printer. You guys might have like editing equipment that would be, more than somebody like I would have. And so maybe you buy those things in December instead of in January, and you take the deduction. You could bonus depreciate them, or there's something called Section 179 expensing. Either way, you should probably be able to deduct that if you're a very small business. And that could be something. Again, it does require cash flow. It requires to have the cash to do it, but that might be something to think about in the ending part of the year.
Yeah. For somebody who's completely debt averse, those last two things we've talked about is very scary, because I'm saying I got to live in December somehow without the income coming until January. And now I'm saying spend more money before the end of the year after I'm delaying income might be. And something we didn't do, Sean, was talk about how easy and impactful these things are. Real quick, let's just go back to delayed invoicing.
Sure.
So how hard is it to delay the income and the invoicing?
The best type of tax planning. So I start with the best type of tax planning has little change to lived experience. But from there, the second best would be, okay, it has no change to lived experience and I have to use a spreadsheet. The third best is I have to do nothing. So this is great. This is like the best, right? Delaying invoicing. You're telling me I have to sit on the couch? I don't even have to boot up the laptop. That's fantastic, right? So
That's a
that's the
one.
easiest.
1 out
It
of
is,
10.
yeah,
Easiest.
it is pretty, I would say it's pretty effective, with the caveat that, well, you're pushing that income into next year. You might be making the fight tougher next year. So that is a thought. And then accelerating business expenses depends on your circumstances and how much expenses, right? If your business relies on one big $10,000 piece of equipment that you have to replace every few years, well, generating the 10,000 might be a little more challenging. But if it's the, hey, I've got 2 conferences, I'll book the airfare in December. All right, that's pretty easy. You can pay the credit card bill in January, and you're still good on that. And then the effectiveness, it's pretty effective. But again, you are favoring this year's premium tax credit battle over next year's premium tax credit battle.
Yep. 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 Maybe upgrading our Descript subscriptions from, a monthly payment to an annual, and we do it in December. That brings the whole payment into 2026. And we give that a number 2 as far as difficulty, and it's pretty effective too. So that's
Yep.
easy to do. And as long as you know what you're doing to yourself in 2027, it's pretty effective. All right, the next one is all you, Sean. I don't even know what you're talking about here. Turn off dividend reinvestment. Don't go away, folks. We'll get back
Yep.
to the fun stuff here in a minute. Turn off dividend reinvestment in taxable brokerage accounts.
And to be fair, this mostly applies for retirees or the semi-retired. So the idea is, when you own brokerage accounts, taxable accounts, so you own mutual funds or ETFs, you own these different investments in there, they spit off dividends, and the dividends are taxable. But what you might want to do is just live off those dividends instead of reinvesting them, because if you're living partially or fully off those accounts, you have to sell those accounts to generate, money to live your life. Well, those sales generate capital gains. This is a marginal play, and it tends to apply a lot more as we're more retired. If we're working full time, this isn't really much of a thing, to be honest. But if we're like sort of semi-retired, we're working part time, this could be a thing where I just use those dividends to to fund my living expenses and create fewer capital gains transactions. So a marginal one, but for the semi-retired out there, it could be impactful.
Do the dividends, are they taxable in the year that they're earned in the
Yes, they are
brokerage account?
taxable regardless, right? Some people think, oh, I reinvested the dividends, it's not going to be taxable. No, it's taxable either way. The play here is that you're avoiding, to a small degree, additional capital gain transactions. That's the play here. Oh, that $1,000 is in my checking account. I don't have to go back into the brokerage account and sell $1,000 and trip a $400 capital gain or whatever it might be.
And you rated this as a difficulty level 1 out of 10. 10 being difficult, 1 being it's pretty easy to turn that off. And then as being effective, you're giving it like a 4.
Yeah, just because it's not, like I'm saying, it's a marginal play. We live in a low yield world. That's a fancy way of saying, take a look at the value of any investment you have and look at the percentage of a dividend it pays. Right now, the US stock market, if you have a broad-based mutual fund, not giving investment advice, but just making an observation, a broad-based index fund of US equities is paying something like 1%. So in theory, if you owned $1 million of a broad-based domestic equity index fund, right, stocks of U.S. headquartered companies, that thing would pay you $1 million, would pay you $10,000 of dividends. Not very much at all. So that does help us anyway. But if you had that and you lived partially off the $10,000, well, that would mean you wouldn't have to do another $10,000 of capital gain transactions. So that would be on the margins helpful.
All right. Roxana says this is all fun stuff for us money nerds.
Oh, excellent.
That's right. That's right. Okay, I got another one from Sean. This also seems nerdy.
Yes.
But he gives this a level, what was this, 2 in difficulty and 2 in effectiveness. So we can reduce our adjusted gross income and impact our taxable income for 2026. Specific identification for sales of taxable accounts. What does that mean?
So this is another one that's more for the semi-retired, solopreneur, where what we're doing is we're living partially off our brokerage accounts. You can Google, just pick your financial institution, Fidelity, Schwab, Vanguard, you pick it. Google that word and specific identification. And these days they typically have like a little one-pager or website that walks you through how to do this. You own a brokerage account and you make sales to, fund your living expenses. You acquire the different things in that brokerage account at different times, dividend reinvestments, actual investments. And so each piece of it has like a different basis, and it'll actually walk you through. It'll have a little, chart of each piece of the holding and what's the built-in capital gain in it. So, what you could do is pick the ones with the higher basis and lower capital gain. And so when we trip the capital gain on our living expenses, we're tripping a little less of a capital gain. Again, this is a timing play. It's marginal and it's essentially a nothing if we're not living off our investments at all. But for the semi-retired, it could be a nice one.
All right. Going to the next one, asset allocation.
So asset location.
Or asset location, right. Sorry.
Yeah. So I sort of think of this as like a matrix. So think about, most Americans who are thinking about their personal finances, saving for retirement. Generally speaking, they have 3 types of accounts. They have their taxable brokerage account. They have a traditional IRA or a traditional 401k. Those traditionals, it's tax deferred. We take the tax deduction on the way in. We call it pre-tax sometimes. So we have taxable, we have traditional, and then we have Roth IRA, Roth 401k. So we have those 3 buckets. And we want to hold different investments. One very basic principle, if we want to hold bond investments, and a lot of folks do, not giving investment advice, but a lot of folks do because they perceive it to have a little more stability and less volatility. Okay, what's a really good place to hold those bond investments? Are traditional retirement accounts, traditional 401k, traditional IRA. The reason here is, recall I mentioned equities today. U.S. equities have like a 1% dividend yield. So $1 million shows up as $10,000 of dividend income on our tax return. Well, what about $1 million of bonds? Well, the yield is higher on those things. It might be 3%, 4%, 5%, depends on the particular holding. So that $1 million, if it's in bonds and it's in our taxable account, that's going to leak out 30,000 or 40,000 or 50,000 of interest income on our tax return. That's upping that income, reducing our chances of qualifying for one of these premium tax credits. So why don't we hold those? Why don't we hide out that interest income in our 401k or IRA? So that's asset location. We locate the bonds inside the traditional retirement accounts where the current year interest income payment can't hurt us for things like premium tax credit.
And I think you gave that a level 2 on the difficulty. So again, it's not that difficult to make those changes, have those in place. And then effectiveness of 4, which is almost middle of the road. So
yeah, and part of the reason I say that is because, just think about the profile of most podcast editors. Podcast editing is a very important function in our economy. Don't get me wrong, but it's also not the tech bro level of income in most cases. I don't know, but and by the way, if you are doing that well, then you're not going to get a premium tax credit, but you don't really need
that's
to be
right.
in this position anyway. So for those thinking about a premium tax credit, they don't. A lot of us tend to have big 401ks or IRAs because that's what you did at work, right? So, a lot of folks are career changers. So they spent their first 10 years W-2, they had a 401k, and that's sort of like the lion's share. So that's part of the reason I put 4 for an effectiveness here is that just based on the profile, it's not likely that you have 5 million in taxable accounts where, boy, I better, locate if I got bonds in there, I'm going to be getting 200,000 plus of interest income a year.
I want to jump to the next one because it's really fun. This only impacts some people, but if you're getting a package, a health insurance package through healthcare.gov, there's a good chance you have the ability to save up for medical expenses in an HSA, health savings account. And the contributions, they're taxed in a different way, a favorable way. You want to explain that?
Yes. So this is a really good one. And there was a change in 2025 that affects 2026 going forward. So ACA medical insurance plans, they generally have these metal tiers: platinum, gold, silver, bronze. The less precious the metal, the lower the premium and the higher the out-of-pocket expenses. Okay. So bronze essentially has a lower premium and a higher deduction proportionately compared to the more precious metals. Okay. In 2025, they passed a law change. They said, going forward, all bronze plans without further inquiry qualify as so-called high deductible health plans. What that means is if you have a bronze plan, period, full stop, you get to make a deductible HSA contribution. So the health savings account is a very tax advantaged account. It's supposed to be used for qualified medical expenses. We're not really focused as much on that right now when we're trying to optimize for the premium tax credit, but frankly, it could. So what we do is we sign up for our ACA plan as a bronze plan. Okay, great. That allows me to make a deductible contribution to a health savings account. That comes off my income, and that increases my chance of getting a premium tax credit, or it increases my premium tax credit if I'm already qualifying anyway. The other thing it does do is, say you fund your HSA for the year, and then late in the year, you have a medical event and you're like, oh, I have a couple $1,000s of medical insurance bills. Well, you now have this tax-free pot of money. You can go into the HSA, grab the money, and fund the medical insurance, the medical expense that way, as opposed to working more or having a capital gain transaction or something like that. So it puts together this nice cycle of, I take the deduction on the way in, which increases the premium tax credit. And even on the way out, it doesn't increase my income, and it's a tax-free source of funding for my medical expenses. I sometimes refer to this jokingly as bronze is gold. It basically meaning for a lot of the solopreneurs, a lot of the self-employed, bronze is going to be something you want to look at because it is medical insurance plan coverage. You got to do you in terms of that piece of it, but it is lower premiums to start. And then it creates this way of getting deductions that could be quite valuable for both an income tax perspective and a premium tax credit perspective.
Yeah, there's a lot of great reasons for HSAs. And the effectiveness there is a two. I mean, it's fantastic. It's what's wrong with tax-free money? It's money you put in, and if at a certain rate you can let it grow. And putting the money in is tax deductible, so that's going to help with your adjusted gross income.
Yep.
Fantastic. The difficulty you put here was a 4, though. Again, almost middle of the road. Because
here's the reason I put that. It does require signing up for a specific medical insurance plan, right? You have to be on bronze. To my knowledge, there are no silver plans that qualify for this. That's my knowledge. Maybe I'm wrong about that, but generally speaking, the deductible is too low. But I could be wrong about that. You got to do your research. But so that's the one reason I said that, because you are like you're essentially cabining yourself. Well, okay, in theory, I could have a platinum, a gold, a silver, or a bronze. Well, now I'm just going to look at the bronze plans. That may not be much of a trade-off for you, but for some people, that is going to be a less desirable trade-off.
Yeah, and one thing about this webinar being in August is we're trying to give anybody who's watching this, who's in a situation like me, we have usually a variable income, and we don't know where we're going to land at the end of the year. But I have time to make these changes before December 31st. Most of the things we're talking about, once December 31st hits, I mean, midnight, 11:59 p.m., you got 1 minute left. You can't really make much change there.
But Steve, to be fair on this one, if you're on a bronze plan in 26 and you're like, I hear that HSA thing, but I'm not so sure. Well, you do have 3.5 months into 27 to make the 26 contribution. So here's how that works, right? Say you're on a bronze plan and you didn't even watch this webinar, or you said, oh, I hear Sean and Steve talking about that, but no thanks. Well, your eligibility, assuming you were on, let's just say 12 months for the year, so you have 12 months of runway to make the max contribution. In February or March, you can fund an HSA. You just have to specifically code it. You have to tell the institution, yeah, this is a 26 contribution, not a 27 contribution, but that you do have a little bit of extra time on this, not on the airline tickets or the new equipment that we talked about earlier, but on this, you would have a little more time.
Now, is that 3.5 months, or are you saying it's up until the point when you file your taxes?
Yeah, so it's April 15th. And my understanding is you could actually theoretically, you can file your taxes beforehand as long as the contribution gets made by April 15th. You're good on this. Most people are going to want to have that contribution made because in theory, if you deducted it on your tax return and then didn't make the contribution, now you've misstated your income and you got some issues there. So you're going to want to make sure you make the contribution and then file your tax return. But it's very powerful.
Yeah. So the one thing you can't change is the plan that you're on in 2026. That's right. But if you have that bronze plan and the capability of an HSA, you can fund that before you file your taxes in 2027 for this year, or up until April 15th, whichever one comes first.
Well, yeah. So it's generally April 15th. That's generally the deadline. So you're allowed to file the tax return and claim the deduction, to my knowledge, right? Because I know this is the way it works with IRAs. Is you're allowed you're allowed to say, okay, yeah, I'm going to fund that thing by April 15th, so I'm going to get my deduction. Again, the big thing is you got to code it as being for 26, because the institutional just default, well, you're in 2027. That's a 2027 contribution. That doesn't help you. And then the other piece of that, though, is also enrollment's coming up for 27. So I think maybe some of this webinar is about, well, how do we optimize for 27? Maybe look for the bronze plan for 27 if you're not already on one.
Great point. Great point. Okay. All right. We're going to move into a couple that shouldn't be, they're all pretty similar, but let's hit them one at a time because they all have differences. A solo 401k. Now, 401k is primarily something that's done with an employer. So yes. How does a self-employed person like me qualify for a solo 401k?
So for those who don't have other employees, or their only employees are their spouses or their business partners, right? People who really own the business. Um, Generally, this could be a really good tactic. Congress has changed the laws several times so that the self-employed have access to a tax deferred, and actually it could be a Roth too, but Roth is not really that effective in this regard. But you can essentially have something like a solo 401k for a one-person business. And why they did that is because these 401ks have some pretty generous contribution limits. And in fact, the solo 401k has very generous contribution limits. For those of us under 50, it's 24,500 as an employee contribution. And then you could do an employer contribution of 20% of your net self-employment income. There's actually a really good IRS worksheet. I believe it's in publication 560 that helps you figure out what the maximum there is. You have some limits here from a cash flow perspective, but this is a way, I've done examples. If you had $80,000 of self-employment income, you're talking about something close to 40,000 that you could deduct through a solo 401k. It's very, very powerful. You got to have the right cash flow. But if you have the cash that's available from the business, boy, oh boy, this could be very valuable. It's tax deferred savings and it lowers your income in the current year. My view is for the solopreneur, this is the best option out there in terms of lowering our income.
And you're saying I could be, as the business owner, I could be the employer and an employee.
Yes.
So I can contribute for both people, which is me.
Yep.
Yep.
And and the other thing I'll just mention is, when I was a W-2 worker, for large entities, it would be like, oh, Sean, you can max out your own contribution. And then there's this little employer contribution, but it might be 3% of your salary, or, maybe up to 6% of your salary. And the employer is balancing different things there. Well, when you're the employer, you're just limited by your cash flow. And there is this there's a tax rule that says basically no more than 20% of self-employment of net self-employment income. But that's 20%. That's not 3%. That's not 6%. You're limited, so the limits vis-a-vis our old workplace plans are actually quite high in terms of taking deductions potentially. But the governor there is more cash flow than it is, the tax rules. Or, like employer plans are great, but the employer contribution tends to be somewhat modest. It can be a lot more in the solo 401k.
And the difficulty level you gave for this was a 3. Not easy, but not terribly hard. But the effectiveness you put as a 1. You're like,
yeah, I mean, in terms of the amounts that can get in here, they're so high. And part of it is because, say that 80,000, that person with the 80,000 of self-employment income, they start with the 24,500 and then can add up to 20%. You got to do a little calculation, but up to 20% of the net self-employment income. You'd be, in that example, you'd be close. You wouldn't get to 40,000, but my quick and dirty math says you'd probably be at like 37, 38, 39,000 of potential deductions. That's pretty powerful.
Seems like a lot of money for people like us. Well, let's move into this one. What's the difference between that solo 401k and a SEP IRA?
Yes.
And
so
how that impacts this?
2 types of contributions: employee, employer. Solo 401k gives you employee and employer, very powerful. SEP IRA is nice, and it's simpler than a solo 401k. Not that a solo 401k is splitting atoms, but it has a little complexity to it, a little bit of diligence. SEP IRA, less complexity, even less complexity, but the SEP IRA only allows that employer contribution. So that 24,500 we started off with, that's off the table with the SEP IRA. So that's part of the reason I'm not as fond of the SEP IRA for this application. But you might say, hey, Sean, my income's high, but it's not that high. 20% of net self-employment income, that's good enough for me. Well, great. Just do a SEP IRA. That's okay too. It's just that the contribution limits are just going to be smaller with the SEP IRA versus the solo 401k. Like I said, solo 401k is not rocket science, but just a little more diligence than a SEP IRA. So in that regard, the SEP IRA is a little better.
And you gave this one a difficulty level of 1, super easy, effectiveness of 3. So still pretty impactful. It might be something that you check off the box on your handout, although we do need to just go into the easy one here. Or do you need to add something?
Well, so I just wanted to add one thing. So some in the audience might be thinking, well, why don't I do a SEP IRA and a solo 401k? I'll just take both deductions. The problem is the the limits coordinate with each other. So it's not like, oh, I'll max out my solo 401k and then I'll do another. No, it doesn't work that way. If you totally max out a solo 401k, employee, employer, well, guess what? Your SEP has now been, you've exhausted your limitation on the SEP. You can contribute zero to your SEP. So anyway, so that I just wanted to add that. Deductible traditional IRA. So this one is, Sean, I don't want to even go through the trouble of doing a SEP IRA. I certainly don't want to go through the trouble of a solo 401k. So I'm self-employed and I'm my only employer and I have no plan. So I have no solo 401k. I have no SEP IRA. Well, you know what I could do? As long as I have earned income, I can deduct $7,500, I should say, $7,500 into a traditional IRA. A lot of folks, when we have W-2 jobs, can't deduct a traditional IRA contribution. But the second you have no coverage in a workplace plan, that, the income limits on deducting a traditional IRA contribution go away. So this might just be the path of least resistance. I'm under 50. I just take my $7,500 deduction. Good. By the way, we might be able to do that for our spouse too. If I'm 50 or older, by the way, I can deduct $8,600. So maybe this is the path of least resistance. I'm going to forgo the SEP IRA. I'm going to forgo the solo 401k, and I'll just deduct into this traditional IRA. There are going to be some people, maybe their income's low enough, you could actually do a SEP or solo and the deductible traditional IRA. That's a theoretical possibility as well. But this might just be the easier path. It's just, all right, I'm 52 years old. I'll take my $8,600 deduction, and that's good enough to get me below the 400% of federal poverty level.
And piggybacking onto that is the spousal traditional IRA that's deductible. So
yes. So here's the thing. Spouses can use their spouse's earned income for this purpose. So, I have a couple thoughts on that, right? So say somebody like Steve works for himself, but also employs his wife, right? In theory, his wife, say she, 20,000, he pays his wife 20,000 as part of that business. In theory, that 20,000 could be a solo 401k for his wife. That's allowed. That's one play. Or he could say, my wife has no interest in this podcast stuff. So I'm Steve Stewart. I do my job. I do my business. Great. I'm happy. And I set up my solo 401k. Great. But my income is low enough that my wife's retired or is a homemaker or just has no workplace plan, then it might be that Steve's wife can essentially borrow Steve's earnings and do $7,500 or $8,600 as a deductible spousal IRA contribution. So there's different permutations and combinations here, but you can have a spouse make an IRA contribution, and the income limits are a lot more forgiving in terms of the spouse, if they're not working and they're not covered by a workplace plan, being able to deduct it. So it might be a combination of solo 401k for the self-employed person and a deductible traditional IRA contribution. You got to run your numbers. You got to look at your situation, but that could be sort of where there's some magic going on.
Yeah, and you gave both the deductible traditional and the spousal a 1 as far as difficulty. Just got to set up the account, get the contribution in on time. But the effectiveness you've got as a 5 on the traditional and a 3 on the spousal. I guess 5, you got to start with somewhere. And if you're doing that for yourself, then that's why it's only a 3 for spousal.
Yeah. So the reason I say 5 is because if you're trying to deduct the traditional IRA contribution, you might be foregoing solo 401k or SEP IRA. So that's a trade-off. You're less likely to be trading that off with the spouse. Depends on your circumstances. But I think all of these are things that should be considered tools in the toolbox. Spousal IRA, or the IRAs, including the SEP IRA, have the advantage of being able to be done after year end. Solo 401k and after year end gets a little trickier. So, that is something to think about. But yeah, there is some play in the joints, just like with the HSA, where maybe we do this after year end. I'm actually going to present before a group of financial planners in the fall. And I've got an example where it's a semi-retired, it's a mostly retired person, but they couldn't give up the side hustle, and they have like the 25,000 of self-employment income. And what do you do? And it's like deductible traditional IRA, deductible spousal IRA. They're on a bronze plan, HSA, and so you could still, even after year end, get a bunch of deductions. It's just good to be aware that these different tools are out there if we're trying to get our income below that 400%.
Yeah, this is probably a good time to remind people to speak with a competent professional before making any sizable financial decisions like this. Yeah. Hey, we do have a comment here from Richard Brown. Solo 401k deductions limits seem so high as to look like sticking it to the government on ACA subsidies. Might the subsidy regime be likely to revisit the MAGI reduction method in the future? I guess he's asking us, what's the government going to do?
Yeah. So just a few thoughts on that. I hear the point about sticking it to the government, but I think you have to think about the constituency we are talking about. We're talking about self-employed people. One thing that I think it's fair to say, being self-employed is difficult, right? It's not a constituency that really should come in for a beating. And anything we could do, when you're self-employed, you're paying both halves of Social Security, for example. You're drumming up your own business, your own clients. Your income is subject to so much more volatility. You're being creative. You're creating a job, right? You're doing really good things for the economy. And in something like a solo 401k, you're generally, you're saving for your own retirement, making your future better, your economic future, and partly the country's economic future just a little better. And so I don't see this as being all that abusive. And we're not talking about people making $10 million here. We're talking about people who are making 5, maybe 6 figures, right? Basically, my theory is you could essentially make low 6 figures, take some of these deductions, and get back below the 400% of federal poverty level. But, I don't know. I just think, when you're a large employer W-2 person, you get the healthcare. I don't know. This is just my own view. I think, these are people who are helping the economy, who are taking risks, who are, funding a solo 401k isn't bad for the economy because you're funding, investments that are, good for the economy and whatnot. So, Richard, I hear your point, and, there's some argument there, but I think there's some countervailing arguments that argue in favor of the self-employed person.
All right, let's move on to the next one. In fact, we're starting to run low on time here. I want to make sure we get all these in before the hour's up, just because I've
all right. So,
what is a QPQ? Blah.
All right. So, this is a technical term I made up. So,
really? That's why I couldn't find it on Google.
Yes. So it's a technical term I made up. And I gave it a little bit of a memorable name. It sounds like an expletive, but it is not. PUCME, previously unreimbursed qualified medical expenses. So you can take your HSA debit card, go to the doctor. Hey, I got the sprained ankle, fix my sprained ankle. Here's my debit card. It comes out of my HSA. I paid for my qualified medical expense. But what you could also do is say, you can whip out your checkbook or your, Bank of America, American Airlines card. Hey, doc, here, receptionist, charge this American Airlines card. I want some points and miles or whatever. Great. Okay. So you pay for your medical expense. And then 5 years later, you say, oh, back then I paid $1,000 for the sprained ankle. I could reimburse myself for that qualified medical expense. And I just take that money out. And that could be a way of sort of accessing tax-free money, is saying, since I got my HSA plan, I've had these previously unreimbursed qualified medical expenses. And part of the play here is there is no time limit for the owner to reimburse him or herself for the previously unreimbursed qualified medical expenses. So I think it's sort of like PUCME is sort of like this register of, since I opened that HSA or AHSA, I've had these unreimbursed medical expenses that I didn't pay for my HSA. I could grab that money as a reimbursement to myself, and I pay no tax on that. I have to report it on a form. It's called a Form 8889. So I report the distribution as a qualified distribution, no big deal, on my annual tax return. But anyway, so that's just a tax-free source
Yeah.
to pay for some living expenses.
That helps with the cash flow in case we're trying to
Yep.
do some of the other strategic things of saving money or putting money away
Yep.
or
Yeah. It's just
increasing
it's a
expenses.
tax-free way of generating cash flow, which
Yep.
is
Yep.
helpful when we're trying to limit our income.
Yeah. Now you gave that an easy of 1 and a effectiveness of 4.
Yep.
I
We
would
have to
think
have
that's
had
pretty effective,
previously, you have
though.
to have an HSA, a previously unreimbursed, it just, there's only so much runway most people have on this. So, but
Yeah.
it's something.
I might have ranked the difficulty a little higher just because you have to have all these things already in place.
Yeah, that's fair. That's fair. Yeah,
Yeah.
maybe on I was a little exuberant on that one, but that's okay.
Yeah, I can't I can't open an account today or contribute today to my HSA and then have unreimbursed expenses outside of the year because it's the year. So, but in the future, I mean, over time, this is a very important thing you could do. All right, and piggybacking on that is also maybe pulling some money out to help with that cash flow, which is Roth IRA distributions.
Yeah, this is something that so the Roth IRA, to give you a little history lesson, I was in college when they introduced the Roth IRA. The Roth IRA turned 28 years old. And I remember when this came out in 98, everybody's like, well, just build up the Roth IRA, have tax-free money, until you're 90 years old, it'll be a gazillion dollars tax-free. And I think now with the premium tax credit being on the table, we have to shift our thinking a little bit. We should use that tax-free attribute of the Roth IRA when it saves the most taxes. And when it might save the most taxes when it turns on thousands of dollars of premium tax credit. I get that we all want to have a Roth IRA worth $10 billion when we're 90 years old. I get it. It's a natural impulse. But how much taxes does it save when we're 90 versus, oh, wait a minute, you're telling me living partially off the Roth IRA tax-free, turn on a $14,000, $15,000, $12,000 premium tax credit, sign me up, So it's just something to think about. And even before 59 and a half, it turns out that most Roth IRA distributions tend to come out tax and penalty free. That's because of the quote unquote non-qualified Roth IRA distribution rules are actually very taxpayer favorable.
Yeah, if the account's been open 5 years or longer, you can take out the contributions without tax penalty. And it
So
doesn't
Steve, let
impact
me get a little more precise here.
Yes.
You can take out your old annual Roth IRA contributions at any time for any or no reason, tax and penalty free. There's no 5-year rule on our annual contributions. And there's an ordering rule. So this is a tax term, ordering rule. Only in the tax world do we have these terrible terms like an ordering rule. But there's an ordering rule that says when you take money out of a Roth IRA non-qualified, so no 5-year rule, no 59 and a half, right? So assume you're under 59 and a half, so non-qualified distribution. The ordering rule says the first thing that comes out is the old annual contributions. That's what we call taxpayer favorable. Because like I said, you can look, you shouldn't do this generally speaking, but you can fund a 2026 Roth IRA tonight, and then in September, you're like, hey, I'm going to Vegas. I'm taking that 7,500 or 8,600 out and I'm just going to go to Vegas. Probably a bad idea, but that's a tax and penalty free withdrawal. It's a withdrawal of your old annual contributions. Terrible planning, but you don't pay any taxes or penalties on it. So anyway, and by the way, maybe people in this space should be thinking more about deductible traditional IRA contributions. Depends on their other situation. Maybe they do a Roth IRA because they're doing a solo 401k deductible anyway, but different conversation. But anyway, so Roth distributions, it's just time to rethink these, especially if we're on one of these premium tax credit and we're living partially off our investments.
Yeah, this will be one of the plays that I have to make at the end of the year, but I'm going to try and take out as little as possible because I'm going to delay expenses. I'm sorry, delay income.
Yep.
I don't really have any expenses I can accelerate.
Yeah.
And then
and Steve, I hear your own.
flow.
It's funny. I hear your own natural hesitation to take money out of a Roth IRA, and I get it. But I'd say, look, why did you build up that Roth IRA, whether you were 30 years old, 40 years old, 25 years old, whatever age you were? You did it to support yourself later in your life in a tax advantage way. Well, what time is the most tax advantage? Like, at what point are you going to get the most tax advantage from taking that money? I would argue for somebody like you, it might be the time it turns on 5 figures of a premium tax credit for you and your wife, right? So it's like, look, I get it. We all want to hold on for dear life to our Roth IRAs, get them to $10 million. So we're the richest tax-free 90-year-old out there. But is that really the most effective tax use of it?
Yeah, this is one of those last things I want to do, but it makes sense. The numbers, the maths out. That's what they say.
Yep.
The maths out. Okay. Uh, Another tactic is to avoid Roth
Yeah, and I
conversions.
see this more with the this comes up more with retired people, although frankly this comes up with employed people, including self-employed people. Hey, shouldn't I be doing Roth conversions, right? And Roth conversions have their role. My view is they've been overhyped in the world. But boy, if I'm going to do a Roth conversion and it's going to disqualify me from 4 or 5 figures of a premium tax credit, I got to think twice, 3 times, 4 times. Um, you know, yeah, I would just say, boy, if you're trying to optimize for the premium tax credit and it can be worth 8, 9, 10, 12, 18,000, 20,000, whatever it is, boy, the last thing I'd be doing is creating more income through a Roth conversion. And so avoiding a Roth conversion at this particular phase, I think makes a lot of sense for folks trying to get a good premium tax credit, not go over the cliff. And the nice thing about avoiding a Roth conversion is another one of those, oh, you're telling me to hang out on the couch. Don't boot up the laptop. I think I can do that.
Yep. And you gave that a ease of one and effectiveness of one, which is great. Now, what about, and I get this all the time, what about charitable giving? Doesn't that reduce my income tax, my taxable income?
So, well, yes, it reduces your taxable income depending on how it's done. Um, yeah, it depends on how it's done, but yeah, let's just stipulate that it could reduce your taxable income, but it doesn't reduce your adjusted gross income. These premium tax credits are measured off something called modified adjusted gross income. For most people, that's simply their adjusted gross income off their tax return. And the problem with the charitable giving is it doesn't slot in there; it slots in later, so it doesn't reduce adjusted gross income, even though it may reduce taxable income.
Now, I always thought, and maybe I'm just it's bounced back and forth how charitable giving comes off of a 1040, the tax return, but
Yes,
charitable giving is always on a Schedule C,
Schedule
which is
A.
Schedule A, excuse me, Schedule A, which is itemized deductions. But if I don't have enough deductions to beat the standard, the thing that everybody's going to get automatically, there's no sense in itemizing, so I don't get the benefit. So is there another place where charitable giving comes into taxable income?
So it can, starting in 2025, actually, I believe. No, 2026, to be fair. They have
So it's this year.
different start
That's why I
dates.
didn't know.
There is this now 1,000 per person cash contribution deduction for non-itemizers.
Oh,
But again, that comes off after we've computed our AGI number. It's not a deduction for AGI, for determining AGI. It's a deduction later on in the calculation from our AGI. So yeah, so even that doesn't help us for this purpose. Our
yeah.
AGI is what we're mostly keying in on.
Okay. So this is an easy to do thing, but the effectiveness is like, it's really a 10. It's the first
Yeah,
10
there's
we've
no
had the whole
effectiveness for
day.
premium tax credit purposes. Yeah.
Yeah. All right. I only got a couple more things here. Let's talk about catastrophic plans. I believe we're now talking about the planning for next year, or
Yes, this is now we're thinking more about 27, right? So you're saying, okay, I'm on an ACA plan this year. I get it. Try to lower my 2026 income. But what about 2027? One potential option is maybe I want to get off this rat race, this hamster wheel of lowering my income. So maybe my business is just thriving and I'm just not, even with your solo 401k, even with, whatever it might be, I'm just not going to get below that 400% of federal poverty level. Well, maybe you sort of lean in as opposed to plan around or plan against. So what this would be is you would sign up in 26 for 27 for a catastrophic ACA plan. They open these up in September of 2025 so that if your income is going to be above that 400%, you could, in theory, sign up for a catastrophic plan. You don't get a premium tax credit, but your premiums might be 20 or 30% lower than a bronze plan. So now you're just managing directly for the premiums. The problem with this was a federal rule change done quietly around Labor Day in 2025. The rollout was awful. My understanding is in many states, the state had no idea what this was. So you could, and even if they did, you had to like get a letter or write a letter. So this is one of those, in theory, it sounds great, but I hesitate to tell anybody, hey, go rely on this. This is your plan. What you could do is start researching this now. And you say, yeah, I just don't want to be controlling for my income. I want my income to be above 400% of federal poverty level. Okay, look into this. But I will say, understand you're going to have to do a lot of diligence and it may not work out ultimately. So that is what it is. But it's one of these things that in theory sounds great. It should be great, but it isn't in practice. But maybe what will happen is, based on the last year being so bad with this, maybe they'll make it better this year. I'm not going to hold my breath on that, but it's a theoretical possibility.
Okay, that's the first I'd heard of that, so that's interesting. All right. And you gave that a difficulty level of 10
Yep.
and effectiveness of 5, middle of the road.
If it
So if you can,
works, I think it'd
yeah,
be fantastic. If you're just like, look, my income is not getting below there, sorry, that's not going to happen. But again, the difficulty is very difficult. So,
yep. And I've got one last one, which is a level 10 difficulty and a level 10 effectiveness. Because what we're trying to do here for the subsidy cliff we're talking about specifically here is we're trying to find ways to reduce our magi. The magi that's based on the family size. 400% of the families, 400% of the poverty level, United States poverty level, based on your family size. So what do? You increase your family size. You adopt a child. And that'll be a way to increase that amount that you could qualify for the ACA subsidies. Of course, it's difficult. You got to execute it before the end of the calendar year. I don't think you can have an extension on this one, can you?
not that I'm aware.
Yeah.
It's funny. My co-author, Cody Garrett, he and his wife adopted a child this year. And so my hope is, Cody's pretty generous with sharing some of his, experiences in life and how they relate to financial planning. So my hope is at some point he does some content around tax planning for adoption. This is a little beyond my expertise, maybe a lot beyond my expertise, but the way it generally works on that is it's generally a tax credit, which is great. That's fantastic, but tax credits reduce the amount of tax we pay. They don't generally reduce our income. And so for premium tax credit purposes, they're not all that effective, other than you did raise a good point. If you raise your family size, then you increase what 400% of federal poverty level is for your particular household, because that 400% thing is based on your household size.
Yep. And that's exactly why it's a 10 difficulty and a 10 in effectiveness. Well, it could be effective, but again, it's so
maybe it's
there.
like an
I just want to
8
bring
in effectiveness.
that up. You're being generous. Sean Mullaney is an advice-only financial planner. You can find him at fitaxguy.com. He specializes in tax strategies for early retirement. In fact, you got a book there. You want to show me the book real quick?
I don't know if you can see that, Steve.
Tax planning.
Go. There we go. Tax planning to and through early retirement. It is on Amazon and other online booksellers. And we talk about the premium tax credit and optimizing for it. So yeah, we released that late last year, and it's really planning based. So it's not focused on, well, these are the exact numbers for this particular year. So I think it has a lot of value outside of any one tax year. That's my own personal opinion, of course, about the book. But yeah, we definitely focus on the premium tax credit, saving for retirement, considerations. What does taxes look like at the end of retirement, and how does that affect us now? When we're saving up for retirement, or where you are in the first part of a retirement. So yeah, thanks for letting me plug that.
Yeah, much more in line with long-term planning, but also for early retirement. So it's going to help you along the way to get to that point where you're not working when you're 55 or 60. And you co-wrote that, Cody Garrett, super smart guy. You both are super smart guys and very giving. You can find that at measuretwicemoney.com/book. That's Cody Garrett's website, measuretwicemoney.com/book, co-authored with the one and only Sean Mullaney, who you can find over at fitaxguy.com. FI is financial independence.
Correct. Yes.
I'm all on
FI
board with
tax
that.
guy. And the blog is somewhat wide ranging when it comes to tax. You don't have to be an adherent to the financial independence movement to hopefully get some value from the blog, but definitely it's sort of aimed a little more for financial independence than maybe some other tax content would be.
Excellent. We've got some people saying thank you in the chat. Roxana says, excellent book with great advice without all the sensational nonsense that some others push.
Oh,
So she's read it.
thanks for the kind feedback there. Really do appreciate that.
Yeah, I'd love to give you my advice, but I'm waiting for the audiobook. So tell
Oh,
me.
so it's interesting. So I will say, Steve, right now there's no definitive plans for version 2, but there's definitely a thought that in the future there would be a version 2. And Cody and I are both open to feedback about what may or may not, should be part of that process. And the issue with the audiobook is there's a lot of tables in here that go through tax calculations. We think we did it in an accessible way. We think it helps illustrate some of the concepts. But I will say tables and numerical content and audiobooks are difficult meshing, and what we decided for version 1, we prioritize speed to market over an enhancement like that. We just made a decision in that regard. I think we made the right decision, but I hear the point that does limit the audience a little bit. And so for version 2, I'm not here to guarantee that we would do an audiobook, but we would at least consider it more. And I think version 2, if it happens, would be a few years off. So hopefully we would at least have some more time to consider it. So we're open to you and others having critiques and comments for version 2. Not that we're guaranteeing version 2, but I would think we're going to, I'm not making an announcement today, but if I had to pick, I'd pick that there probably will be a version 2.
Yep. And just as everything, when it comes to authoring books about tax code or anything that has to do with taxes, retirement savings have to do with taxes. There's changes along the way. So I bet you have a revision, and it'd be sooner than like 10 years. I see people revise their books after 10 years.
Oh, I think it would be sooner than that.
Yeah, it's got to be before that. So, and just like taxes and retirement savings, it's just like podcasting. The answer is always it depends. So Sean, thank you so much for being on this episode of the Podcasters Mastermind Show. And I appreciate your friendship and all the advice that you've helped share today.
Thank you, Steve. Really enjoyed the conversation.
All right, I'm going to put him in the back room for a couple minutes, hopefully 1 minute. Thank you all for hanging out. I hope you get a lot out of this. The replay is going to be available. There will be chapters in the audio podcast as well. So if you want to go to Podcast Editors Mastermind Show is the podcast that the Podcast Editor Academy puts together primarily for my audience, which is podcast editors, but obviously this is a very helpful tool for anybody looking to plan for the future, save on taxes, and of course, avoid the subsidy cliff. So I appreciate you all being here. Thank you for your questions and your contributions.